Today, we delve deep into understanding how compound interest works and how you can harness its power to build your own financial future. Whether you are just starting your investment journey or looking to optimize your current strategy, this video will provide valuable insights into making compound interest work for you. At its core, compound interest is interest earned on interest. This might sound simple, but its implications are profound. To understand this better, let's contrast it with simple interest. With simple interest, you earn interest only on the principal amount. For instance, if you invest $1,000 at a 5% annual simple interest rate, you'll earn $50 each year. However, with compound interest, each year's interest is added to the principal, and the new total becomes the base for the next year's interest calculation. Let's see how this plays out with an example. Imagine you invest that same $1,000 at a 5% annual compound interest rate. In the first year, like simple interest, you earn $50. But in the second year, you earn interest on $1,050, not just the original $1,000. Over time, this effect snowballs. After 10 years, your initial $1,000 grows to about $1,629, compared to just $1,500 under simple interest. This might not seem like a big difference over a few years, but compound interest's true power shines in the long run. Let's say you keep that $1,000 invested for 30 years. Under compound interest, it grows to approximately $4,322, far outstripping the $2,500 you would have with simple interest. The earlier you start, the more you benefit from compound interest. This is because the growth accelerates over time. To illustrate, consider two investors, Alice and Bob. Alice starts investing $1,000 annually at age 25, while Bob begins doing the same at age 35. Assuming a 5% annual compound interest rate by the time they're 60, Alice's investment would have grown to approximately $126,840. While Bob's would be about $62,440, even though they invested the same amount annually. Warren Buffett's investment journey epitomizes the effective use of compound interest. He made his first investment at the tender age of 11 and has since consistently applied the principles of compound interest, allowing his wealth to grow exponentially over decades. Buffett often stresses the importance of reinvesting earnings to generate more earnings, a direct application of compound interest. He once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." This statement underscores his belief in the power of compound interest as a wealth-building tool. Buffett's approach also emphasizes patience and consistency. He doesn't chase quick wins or high-risk investments. Instead, he opts for investments with solid long-term potential and allows compound interest to work its magic over time. This method demonstrates the importance of seeing beyond short-term market fluctuations and focusing on long-term growth potential. One of the most effective ways he utilized compound interest is through investing in the stock market. Let's break this down with a straightforward example. Imagine you invest $1,000 in a stock that pays dividends. For simplicity, let's say the stock has a dividend yield of 4% per year. In the first year, your investment earns $40 in dividends. Now, here's where compound interest comes into play. Instead of taking that $40 out, you reinvest it back into buying more of the stock. So now, you're not just earning dividends on your original $1,000, but on $40. As years pass, this cycle continues. You earn dividends on an increasingly larger amount as you keep reinvesting your dividends. Over time, even if the stock price doesn't increase dramatically, your investment can grow substantially because of this reinvestment. For example, if you continue this process over 20 years and the dividend yield and stock price remain fairly constant, your initial $1,000 investment could grow to over $2,200, just from reinvesting dividends and benefiting from compound interest. This doesn't even account for any potential increase in the stock's price itself. Companies can pay dividends annually, semi-annually, quarterly, or even monthly. Once you research and find the stock, look for a section titled Dividends or something similar. This section will provide details about the dividend payments. Many financial websites also provide a dividend history section where you can see past dividend payments. This can give you an idea of the consistency and frequency of the company's dividend payments. Applying the principles of compound interest isn't limited to stock market investments. It's a principle that can be incorporated into everyday financial decisions. Firstly, consider savings accounts. While the interest rates on savings accounts might seem low, choosing an account with compound interest, as opposed to simple interest, can make a difference over time. Look for high-yield savings accounts or certificates of deposits, CDs, that offer compound interest. Next, let's talk about debts. Just as compound interest can grow your investments, it can also escalate your debts, particularly with credit cards. High interest rates on credit card balances capitalize on the same principle of compound interest, but this time against you. This is why it's crucial to pay off high-interest debts as soon as possible. In retirement planning, compound interest plays a vital role. Retirement accounts, like 401k and IRA, often invest in the stock market, and the reinvestment of dividends and capital gains harnesses the power of compound interest. The earlier you start contributing to these accounts, the more your retirement savings will benefit from compound growth. To effectively harness the power of compound interest in your financial strategy, it's essential to use the right tools. There are several resources and apps available that can help you calculate and project the growth of your investments and savings due to compound interest. Online calculators are a fantastic resource. They allow you to input your initial investment, the interest rate, the frequency of compounding, and the investment period to see how your money can grow over time. Websites like Investopedia, NerdWallet, or Bankrate offer these calculators for free. Remember to choose the right investment vehicles. Invest in options that offer the potential for growth and compound interest, such as stocks, mutual funds, or retirement accounts. Compound interest thrives over the long term. Avoid the temptation to withdraw your investments early. Let time and compounding do their work. By starting early, staying consistent, and making informed decisions, you can harness the immense power of compound interest, just as Warren Buffett has. If you like this video, hit the like button and subscribe for more finance videos. Thank you for watching.